Okay. Look, welcome everyone that's joined to our investor briefing. We thought we'd best to do this. Things are also familiar with Zoom and give everyone an opportunity to have a look at this presentation and talk to both John and myself with any questions. For those that don't know me, my name's Tim Watson. I'm the current chair of Namoi Cotton. I sit on the board as a grower director, and also leading the presentation this afternoon will be John Stevenson, who's our current interim acting CEO. Also present with us as observers, we have a number of our directors. I'm not sure of all of them, but I think most. We've got Joe DeLeo, Juanita Hamperson, Glenn Price, and Ian Wilton. So welcome to them, as well as everyone else who's joined. First of all, a little bit of protocol. Could I ask that everyone mutes their microphones? And we just hold all questions to the end. Zoom can be a bit frustrating at times, and so if we just keep the questions to the end, we'll try and give everyone an opportunity to raise a question. Look, I suppose before I hand it over to John, for those that are not familiar with Namoi, I thought I'd just give a brief history. Namoi Cotton was formed as a cooperative 58 years ago. It's the leading provider of ginning and marketing services to the Australian cotton industry, and we regularly gin in excess of 25% of the Australian crop. We had a number of iterations, but the major one was in 2017. We restructured from a dual listed company with grower controlled share listing to a single straight ASX listing. We did that just to simplify the structure and really free it up and make it easier for us to access capital when and if we needed it in the future. And John will lead on to that a little bit later on. Safe to say Namoi is dependent on weather, and the last few years has been pretty trying.
You've got on mute, Tim.
How did I do that? Where did I get up to, John?
Just starting on the history, Tim. Just starting on the history.
Sorry, I don't know what's going on there. So formed 58 years ago, restructured in 2017 to a straight ASX listed company with a simple one class of shares, and not so the significant thing there is that we're not grower controlled anymore. It's safe to say Namoi is dependent on weather, and the last 3 years have been pretty trying for Namoi. We've had some of the worst drought conditions on record, and that's been a real challenge for the board and for management. We've used the last few years to really right-size the business and take a good hard look at our business and try and focus on removing as much cost as possible. John will touch on that a little bit later on as to what we've been able to achieve. Also, recently last year, we renegotiated our joint venture with Louis Dreyfus in the NCA marketing arrangement. The prime objective there was to de-risk the business, and what happened to Namoi in 2012 was that due to extreme trading environment, Namoi lost a lot of money. What we've done and what the team was successful in doing last year in renegotiating the terms of that joint venture is that we've de-risked the business, and that can't happen again. we've limited our exposure, and we can't have another situation like the 2012. So that was a really significant event. We've now strengthened that partnership with Louis Dreyfus, and safe to say it's really working well. The warehouses are working well, and the marketing, and we're better aligned with them. So we're looking forward to the future with that in a de-risked environment. With that and the recent rain, the dams, a lot of the dams, farm dams are all full. Growers are full of enthusiasm. The cotton price is good. Namoi currently is positioned really well to take advantage of these conditions, and that's what we've been about, and that's what we've been trying to achieve. So probably I'll leave it at that and hand it over to John to run through the presentation, the annual results, and give you an update on the recent capital raise.
Thanks, Tim. Good afternoon, everybody. I'm going to share my screen here, so just bear with me for 1 second. There's been a lot of activity for us in the last week or so. We wanted to take the opportunity to explain our results and our strategy, and this was an opportunity that we wanted to give all interested parties the opportunity to participate. So this presentation here is the presentation that was lodged with the ASX on Monday of this week. So you all have access to it. It's publicly available. What I am going to do is slightly change the order of the presentation. The presentation was in a slightly different order. I'm going to talk firstly about FY21, our financial results, and some of the things that we've been doing in FY21. I'm then going to talk about strategy and the outlook for the coming years. And then finally, I'll finish off on the capital raising process that we've just undertaken and announced to the market on Monday. So I believe that I'll finish this presentation in 20-30 minutes, which will give us 15 minutes or so at the end for questions. So please, we'll have plenty of time for those questions. As I'm going through, if you think of a question, you can put it in the chat box, I think, and send that through, and I'll have that ready to answer at the end of the presentation, if that's easier for you. But we're also, at the end of the presentation, you can ask any questions you like there as well. So let me kick off with a summary of FY21. Look, there's a lot of numbers in this page. I'm really just going to pick on a number of key themes out of here and try to highlight some messages in these numerical slides. You'll see there in the middle, we recorded a profit before tax, or a loss before tax, sorry, of $16.5 million. Significant number compared to the prior year, $15 million loss. That $16.5 million loss reflects the volumes, the historically low volumes that we processed in 21. 124,000 bales we ginned in 2021. That's 80% below our 10-year average, historical low volumes, and that was the driver for the significant loss. But there's been a lot of restructuring going on in the business during FY21, and these numbers, you don't necessarily see that out of the headline numbers there. And therefore, I just want to pick up on a couple of numbers in here. The $16.5 million loss includes a $7.2 million loss from our marketing and lint trading business, joint venture with Louis Dreyfus. This is our 51% joint venture prior to the restructure that Tim talked about. This $7.2 million loss reflects the significant reduced volumes as for ginning, but it also reflects other volatilities in the lint trading business. We've had a significant political volatility. China had some ups and downs in terms of volumes, and we've had significant losses in that business resulting from a whole range of volatility. And the other number I want to highlight there is the unallocated, which really represents our corporate costs that aren't allocated directly to ginning or to other divisions. You'll see that that's come down roughly 50% from last year. There's been a significant amount of work in terms of bringing our cost base and our break-even point down. And now I would also point out that unallocated cost includes a $2 million JobKeeper revenue, but there is also a significant reduction in fixed costs in that number. The last number I want to point out is the ginning and co-products number there. You'll see that on 124,000 bales, the ginning business roughly break even. And this is a significant sort of restructure that we put in place, and it positions us well for when we return to volumes, return to the increased crop sizes that we're looking at. So removing those joint ventures, we've got an underlying EBITDA of negative $4 million versus the prior year $4 million. So there's been a lot of restructuring, and what we have managed to do is, despite a 70% or so reduction in volumes, we've been able to limit that loss from the prior year $15 million down to $16 million this year. If I looked at balance sheet and cash flow, the key points I want to come out of these slides. Firstly, the capital employed. For those people who don't know the business all that well, the capital employed, the ginning and other assets in our investment in NCA, it's all tangible assets. It's all equipment and land and equipment and machinery. There's no intangibles in that number. The second number I want to highlight out of this slide is the net cash outflow. In FY20, on a $15 million loss, we had a net cash outflow of $3.6 million. This year, we've focused really hard, despite that significant reduction in volume. We've really focused on cash flows. We've restructured the working capital. We've taken a very proactive approach. We've sold surplus assets. And of course, as I mentioned before, we had JobKeeper support, but we've actually reduced the cash outflow in FY21 despite an increased loss, despite the significant reduction in volume. So they're the key financial metrics I wanted to pick up on, and I'll touch on anything else if you've got it in your questions. But from an operational perspective, FY21, we've focused heavily on our improvement in safety. We've had a constant reduction in the LTIFR numbers, and we're continuing to improve that the safety culture in the business. On the right-hand side, you'll see there that we are forecasting for FY22, that is the 21 cotton production. We're forecasting to gin 450,000 bales. Roughly equivalent to what we did in FY20. We have already announced we're operating 8 of our 9 gins. We've completed all maintenance. We've just started ginning right now. We've reopened some gins that have been closed for a number of years. In particular, Burke gin has been upgraded and it's operating now. We've reopened our Warren warehouse, which has been closed, and the interest in the forward bookings in there has been solid. We've got over 90% of that 450,000 forecast bales is already contracted and is already starting to be delivered. And therefore we're very confident that we will hit that 450,000 bale number. it's been any growers on the call will know it's generally been a late start given the flooding rain that we had in March. But we haven't seen any significant reduction in yields from that flooding rain, and in fact, if anything, we've seen some really good, some excellent yields in certain areas. So we're very confident of meeting that 450,000 forecast for FY22. That covers FY21, and again, anybody wants go into detail, I'm happy to do so at the end of this presentation. I do want to spend probably the bulk of the time on our strategy and our outlook for 22-23. This slide really covers what Tim gave in his introduction. The top half of this slide outlines the history from co-op to a conversion into an ASX listed company in 2017. And the bottom half really the headline here is simplification of the business. This started with a divestment of our joint venture operation with Cargill in terms of cottonseed crushing. And in addition to that, as you saw in the last 1 year or so, the restructure in the joint venture with Louis Dreyfus. I mentioned before that our joint venture with Louis Dreyfus was a 51% joint venture in NCA. That up until this year included logistics, warehouse, packing, and lint marketing and trading. The restructure has taken that lint marketing and trading out of that 51% joint venture and has moved it into a new joint venture called NCMA, which is a 15% share for Namoi Cotton, 85% Louis Dreyfus. Louis Dreyfus responsible for the funding of that business. Our own exposure, Namoi Cotton's exposure, is now limited to our 15% share with some caps on the potential profits and losses, 1.5 million caps per year. Significantly de-risks our business, and our focus now is on producing as many bales as possible that go into that marketing business for which we receive a fee for every bale. So that bottom half of that slide really highlights the simplification and the simplification not only in our operations but in our balance sheet, because we've now moved away from the need to provide debt funding for that lint marketing business. That is now fully funded through Louis Dreyfus. That has simplified our balance sheet and allowed us to focus on our working capital needs for ginning and byproducts. This slide gives a graphical presentation of where our footprint is, and it also talks about the fact that we're not just a ginning company. We run supply chain, we run warehouses, rail networks through to Brisbane, Sydney and Melbourne. We are a major supplier of cottonseed to domestic feedlots in Australia, as well as export feed. And through our joint venture with the restructured joint venture, we maintain an investment in cotton marketing. So this business, it covers a whole range of areas. Historically, the bottom right-hand box, the cotton marketing box, has been a pull for this business. That is, it's been a focus of operation and activity, and it's pulled volumes through the ginning business. With our restructure, we have just changed the focus of that. Our focus is now on the ginning business, and it's at the heart of our whole operation. And that ginning business, you can see there, our 10-year average volumes is 835,000 bales, and that actually excludes one gin that has been closed during that period. So that's our average volume. That's what we would expect to receive in the years going in an average season. That drives volume through our co-product co-products business being predominantly cottonseed, but also trash and other byproducts, and also feeds volume into our warehouses, and also maximises our rail lengths, and also supplies volume into our marketing business as well. But I really want to emphasise that the ginning is really the heart of our business, and that is driving our strategy going forward. Just want to touch on this slide, a couple of points from this slide. And on the left-hand side, the immediate 10-year, the preceding 10 years, you'll see that the average bale, the average production in Australia is 3.4 million bales. Point I want to make here is that it is up, it's almost double the previous 10 years, which was at roughly 2 million bales. So despite the volatility, you can see in those columns in the last 10 years to 2021, you can see significant volatility in those years, particularly in 20 and 21, 19, 20 and 21. But despite that volatility, you've still seen a significant rise in average production in cotton production in Australia. That reflects the quality and that Australian cotton and its position in the global markets. On the right-hand side, just want to highlight here the diversity in export markets for Australian cotton. Over a 5-year, not only Australian cotton, but for all global cotton, the 5-year average of imports into these countries, you'll see that China stands at 17%. There has been significant volatility in the Chinese profile. We've had a lot of media about the positives and negatives about the relationship between Australia and China. Really just want to highlight that the volumes are not, we have significant other markets that Australian cotton is exported to, and in the last year we've seen increase in demand from the traditional markets of Bangladesh, Vietnam, and Indonesia in particular. Namoi is Australia's largest ginner. We hold 20 to 25% of the Australia's share of the Australian production and ginning of cotton in Australia. As I said earlier, our average 10-year average is 835,000 bales. And in our catchment areas, we have a 35 to 45% market share. That chart on the left-hand side shows that calculation of 835,000 bales, and not surprisingly, you'll see that same volatility in that 2021, 22 years. On the right-hand side, that chart separates the blue bars represents our ginning business, our ginning and co-product business, and excludes all of our joint ventures, which is the supply chain and the cotton, the lint business, trading and marketing business. We did this to just highlight the earnings from our underlying ginning business. And when you do that and you look at those blue bars, solely those blue bars, clearly you see the volatility in terms of weather, but you can see there that our average 10-year average underlying EBITDA in the ginning and co-products business, net of 100% fixed costs. Just highlight there that is net of 100% fixed costs, albeit some of those costs would be related to managing our joint ventures. But that is a net underlying ginning business with 100% fixed cost, 100% costs. We're showing a 10-year average EBITDA of $14.5 million. And that's on your average 835,000 bales. This slide just highlights the simplification that I spoke about earlier. The right-hand side talks about the joint venture restructures. I hope Jim or Sarah Jane, can you bring in a PowerPoint maybe for me? The right-hand side just talks about the restructures that I've already spoken about. I don't need to go into that in any greater detail. Just want to talk about our cost structure on the left-hand side. Those columns represent our full-time and permanent employees. What you can see there, if you maybe not clear on the numbers there, but FY19 we had just over 150 full-time equivalent employees. FY20 we finished the year at just around 90. So we've had a 60. Apologies. Apologies. I'll keep running. Somebody will come in very short. Give me 30 seconds.
Do you want me to share my screen?
That'd be great, Tim, if you could. Thanks, Tim.
You see that, John?
I can.
Tell me.
You just go on to the next. Yes. So you'll see. So just go back one there, Tim. Just wanted to finish off on this slide. You can see there we've had a reduction, a reduction in full-time equivalent or permanent employees, around 60 employees in the last 2 years. However, that is going to, we estimate that with increased volumes, we're going to need to increase our staffing. But we believe that the increase will leave us with a permanent reduction of roughly 30 full-time equivalents. And that number underpins the reduction in what we believe is roughly a $4 million reduction in fixed costs that is going to benefit us permanently going forward. As volumes increase, there will be a need to increase staff, but on the downside, in lower years, we'll have a lower cost base and a lower break-even point. That's the restructure. That's the result of the restructure that we've just completed. Next slide, Tim. This is the just want to talk about the outlook. We've had with the recent rain, we've had significant catchment improvement in water catchment, not only in public dams but in particular in on-farm dam, and the outlook is significantly improving. I'll touch on 23 in the next slide, but for FY22, which had already been planted the crop had been planted prior to this recent rain, we're seeing roughly a 4 times increase in volume in cotton production. But more interesting, more attractive as well for us is the warehouse bales there. You can see on the third slide, the third point there on the right hand side. We've seen a fourfold increase in our warehouse bales, and we're seeing significant interest for or more bookings in that warehouse. So this business compared to FY21, 131,000 bales. We expect to be 70-80% utilised in FY22 in our warehousing, and that has also flown through into grain packing and the great harvest that we've had in that area. That's 22. If I touch on 23 on the next slide, Tim. '23 is going to benefit, the growing season is going to benefit from the increased dam storage water that we've got now. You can see here on the left-hand side, on that chart there on the left-hand side, what we've done is charted our ginning production in the columns with the water dam levels, the public dam levels in our catchment areas. So not on-farm storage, this is just the public water dam levels. And you can see there, not surprisingly, there's a direct correlation between water storage volumes and ginning production. The line follows it goes through to April 21, And you can see there that we're still seeing further increments or increases in water storage, in water levels. But you can see there that line is pointing at a 900,000 bales season for FY23. And on the right-hand side, really just talks about you're starting to see more and more other industry forecasts. And those industry forecasts in general are predicting a 1.5 to 2 times increase in FY23 or 22 planting crops versus 21. And that, particularly in our catchment areas, it varies slightly in different catchment areas. So, but in our catchment areas, we're looking at the forecast increases of 2 times versus FY22 or 21 plantings, and hence where that is also pointing to a 900,000 bale season, which would be just above our 10-year average for 23. Next slide, Tim. This talks about, I just want to then talk about where our strategic planning is going. We have focused on, not only have we restructured the business and simplified it, but we're also strengthening it through our focus on strategy. We've developed a new strategic plan which focuses on 4 key areas. For this 4-point program, 1 talks about our investment, as we get heading to higher volume seasons and we generate cash flow, we will reinvest in our equipment and machinery. We see huge opportunity in improving the efficiency of our production, and there is upside and great return on investment in terms of improving the efficiency and speed of our gins. That's the first program. The second point in this program talks about innovative and sustainable solutions for our growers. With our shift from a lint pull business into a ginning push business, we're also refocusing our attention on providing as many pathways to market for growers. That is not only for their lint, but it also covers their seed and any other logistics, any other solutions that they need. We are here to provide an independent pathway to market for growers, and we are improving our team in this area and are constantly working and will continue to work with growers now about designing solutions for their businesses. The point 3 here is about broadening our revenue base. We are predominantly dominated, our traditional valleys are in New South Wales, spanning from the south through to the north. We are looking at participating in the expansion of the cotton industry, or the footprint, which is now, there's work underway to improve or expand the growing into Queensland, Northern Territory, Western Australia. We're participating in these conversations about wanting to be a ginner and a logistics supply chain provider in these areas, and we are very keen to expand our revenue base into those new greenfield areas, but also we are very keen to look at diverse consolidation opportunities in both our existing valleys, but also in Queensland. So this is will be a key area for us going forward. And point 4 here is really talking about building a sustainable ginning workforce. We will be investing in creating a training regime and providing an attractive work environment for our staff. This is key for us. You no doubt would read the challenge of finding and engaging workforce in agriculture in Australia, and this is a key area for us to actually differentiate ourselves and create an attractive environment for workers. So this 4-point plan, you'll hear us talk about this now going forward. This is driving our assessment of opportunity, and we need to ensure, we will be ensuring that we get a proper appropriate return on investment in any of these areas. That will be driving our focus going forward. Next slide, Tim. This slide really just shows that previous slide in a graphical form. The top half talks about what type of solutions we can offer to our customers, whether it be on the right-hand side through warehousing, through storage of products in order to change the point of sale, the timing of the point of sale. Growers may choose to warehouse and their product and then tender it rather than take offers earlier or on farm, and other logistics solutions that we can offer. On the left-hand side, we will be looking at new products, and in particular, we'll be looking at how we can make the process easier through digitisation, whether that be just in logistics or whether it also be in a trading platform. But we will be looking at opportunities in that space. On the bottom half of that chart, really just talks about the broadening of the revenue base. On the left-hand side is geographical. On the right-hand side, it's product-driven. And we see opportunities in particular in the co-product area. We are a major supplier today into the feed market, into the livestock feed market, into the cattle feed market. We see opportunities to expand and to look at parallel opportunities in those markets. Next slide, Tim. I think I might need to go right back to the beginning, Tim, on about slide 4. And I'll just finish off with a summary. Yep, that one. Yep, thanks, Tim. That one, really just to finish off on the capital raising process. I've just given you a background in terms of the significant reduction in volumes that we faced in 2021, even 2021. You can see from there the impact that has had on cash flow, and clearly that's had a negative impact on our balance sheet and our funding. I've also then talked about the outlook. We're looking at significant increases in volumes, and we're looking at a significant improvement in cash flow. The capital raise that we announced on Monday had 2 components to it. We did a 15% placement. That placement was heavily subscribed. We had significant interest from existing and new shareholders. And we announced on Monday that we placed that $7.2 million into the market. The second part of that is the share placement program that we announced, the SPP we announced. We really want to encourage as many shareholders, if not all, to participate in the SPP, take up their rights as much as they can. The maximum they can take is $30,000 per individual shareholder. That will be at a maximum price of 34 cents, or wherever the weighted volume ends up over leading up to that closing date. So we're looking to raise anywhere from we believe $10 to $12 million. But just that $10 to $12 million is going to get us ready. That money is there to get us ready for the 4- to 8-fold increase in volumes that we're looking at in the coming 2 years. That's the priority for this money. It helps us restructure or strengthen our balance sheet. It also sets us on the pathway to implementing that strategic plan that I outlined there. This money will help us give us the support to get us ready to undertake that work. So just want to finish off there. I will now open that up to questions, and then when we finish questions, Tim will give us a summary of that and just finalise there. So I'll open it up to questions.
Any questions, anyone? No. You must have answered them all, John. Must be very comprehensive, detailed presentation.
Yeah, look, if anybody, I know it's difficult in Zoom and we have covered a lot of area there, don't hesitate to reach out to us, to me, or Tim, or anybody else who you have is your primary contact. Don't hesitate to contact us if you do have any questions. I appreciate you may find have a question later on, so don't hesitate. But Tim, I'll hand over to you.
Yeah, thanks, John. I think that's a good point. We're open for to the discussion, and please give us a call. Any one of us, reach out, and we try and answer any of the questions that you might have. I'd probably just like to take this opportunity to thank those of our existing and new shareholders that have participated in the placement. It was overwhelming, the confidence in Namoi Cotton. So thank you very much to all of those that did support us. And just like to reiterate with John, that encourage everyone who can participate in the SPP coming up. We'd really like you to consider it and look at the future for Namoi Cotton, and hopefully vote with your checkbooks. So probably on that end, I'd thank everyone for their attendance today, and look forward to a good 12 months for Namoi Cotton.
Thank you.
Thanks, everyone.